makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, the EU and the US have barely 6 weeks before the tariff clash triggered by Donald Trump escalates with fresh duties. Now, Brussels says it will accelerate negotiations with Washington to avoid a transatlantic trade war. At the same time, the ECB President Christine Lagarde says Trump's policies offer a prime opportunity to strengthen the euro's international role.
Moments of change can also be moments of opportunity. The ongoing changes create the opening for a global euro moment. And this is a prime opportunity for Europe to take greater control of its own destiny. But let's not fool ourselves. It is not a privilege that will be bestowed upon us.
Well, let's discuss all of this with Karen Ward, EMEA Chief Market Strategist at JPMorgan Asset Management. We're also joined by Rosalind Matheson, our EMEA News Director, to discuss the big geopolitical moves. Now, that's also as the German Chancellor Friedrich Merz says Ukraine has been given permission to use weapons supplied by its allies to launch strikes deeper into Russia. So thank you both for joining us. Karen, let's start off with you. There's a lot going on, right? There's a lot of news when it comes to Japan, with the finance ministry actually asking things to market participants. But I was struck by the fact that Lagarde says, this is a big moment for Europe and we want to put euro at the center of it. What are the benefits of actually being a reserve currency?
Well, this is the thing. I always think Europe is actually best in a crisis. It's when nothing's going on. We tend to do bad things, over-regulate, not get deeper union. And I think she's exactly right to say this is the moment and we will be forced. And we're already seeing that. So in terms of, what needs to happen, we've been talking about things like capital markets union in Europe and how that would benefit the flow of capital. Things like this, I think, will really push those conversations that have been faltering to actually come over the edge. What's the benefit of being a reserve currency? It's access to capital. The US has had the world's capital flowing to it for the last 15 years in abundance. It's been a huge part of why they've been able to grow, why their companies have been able to grow, why governments have been spending a lot more in the US than we have here in Europe. So there are big upsides to having that abundance of capital.
I mean, a lot will depend on the US-EU tariff negotiations, which we'll talk about in a second. But is now the moment to be invested in European markets, or are there too many question marks?
I've been saying since we came into the year, we had a situation where the US was believed to be exceptional and Donald Trump was going to further exacerbate that exceptionalism. Expectations on the US were too high. Expectations on Europe were too low. And what we're seeing, I think, is people starting to look at Europe again. And I think that this has a lot further to run in answer to your question. Europe is stimulating in all aspects of policy, monetary, fiscal, regulatory, and I think we're underestimating actually how much growth that can unleash. And I keep saying to my clients, stop focusing on the last 15 years. Go back in time. We have had periods where corporate earnings in Europe have been good. I think we've got this perception that Europe structurally can't grow. We're structurally incapable of delivering earnings. And I think that's not right.
Yeah, and Roz, this points to the fact, to see that longer-term success, I think a lot will depend on what the EU can negotiate with Donald Trump. So what are we expecting in terms of tariffs? He's, for the moment, giving 90 days for Europe to see what happens next. And is von der Leyen the right person to negotiate this?
Well, clearly she's got some traction, but maybe also the markets helped ahead of that call with Donald Trump. But they're back at a bit more time to try and negotiate something, and they're talking about fast-tracking talks. We know that there was a call last night, again, between the chief negotiators. That the view is that call went pretty well. So things at least have settled a little bit. The question is, how do you fundamentally get to an agreement when you're so far apart? Because the EU has its red lines here, and the US does too. And interestingly, in all of this, what it's actually been a reminder of, to Karen's point, is that the EU is actually quite a big economy collectively. It's much more serious to deal with in negotiations than, say, getting a trade deal or an agreement with the UK. I mean, it's much bigger, and it's got that heft that comes with it. It has those complications, of course, as well, but it's a much bigger deal. And that's what the US is recognising. The question is, they're so far apart on everything. Can they maybe pick this apart in ways? Can they say, let's focus on some specific sectors? Can we get traction at least on something? I mean, there's automobiles, there's pharma, there's a lot. Can you pull it apart a tiny bit? Can you look at non-tariff barriers, separate things out? Or do you have to try and get a collective deal in one go, which is much, much harder?
Yeah, and I guess, the biggest concerns for Europe is that a lot of countries have different views and there's no real figurehead. I know it feels trivial, but Macron was also presenting himself as one of the big statesmen and leaders. And then we all saw that video of him coming out of, the French plane in Vietnam. I don't know whether that hurts actually his credibility on the world stage. I don't know whether Christine Lagarde can fill that void with that, pretty powerful speech she gave yesterday.
Well, as you say, unity is both a benefit and a challenge for the EU, and having leaders all speak with one voice, especially when it comes to Donald Trump. But in fact, you are sort of seeing that. I mean, the new German Chancellor Friedrich Merz seemed to be developing his own relationship and perhaps taking things in a different direction, now very much echoing what the rest of the European leaders are. And you say there's always that question of individual benefit versus collective good, and that's the challenge for the EU, and a strength and a weakness. But they do seem to be holding the line here, and they're making very clear they will retaliate against Trump if these tariffs do come on. To your question about Macron, he's in Southeast Asia because Europe is also recognising, again, you've got to diversify your relationships. And for years, Europe's been trying to find a way to play a role in Southeast Asia. You've got China and the US, Southeast Asia caught in the middle. What's the role of Europe in all of that? So he's there to talk about trade, he's there to talk about mutual defence and so on. There was that video of him coming off the plane. There's been a lot of conversation around that video. His people are saying it was a moment of playfulness. They were having a bit of a joke with each other. Whatever you make of it, he's obviously very focused on what's going on in the region. And he's about to make a big speech on Friday night at Shangri-La at the summit in Singapore, and where he will probably lay out again what is the path of Europe in Asia, but also, trying to keep people together on Ukraine.
Karen, what do you respond to the naysayers that say, look, Europe is well and good, they'll spend a lot on defense, but actually they just don't have these big companies that will lead the way on AI? So without the Magnificent Seven, Europe will always be lagging the US.
Well, I think it's actually a question whether through the whole course of the year, the Magnificent Seven will be, seen to be such a benefit. One of the interesting things of the long period in which when Europe did outperform was because that was when tech was in the doldrums, and expectations on tech are very high. If we do go through a more challenging period for the tech companies, that might be one of the things that stands in Europe's instead in order its performance. But I think generally, it's for me, the story in Europe is slightly more about the consumer. We're seeing now real wage growth that we haven't seen for quite some time. Our inflation shock was much bigger, much more persistent. And also interest rates still work here in Europe. They don't work anymore in the US. But the ECB, when it took rates up, that hurt. And I think as that gets released, then that's going to bring about a consumer, a domestic small business story. And, we'll see. Defense, there's the whole discussion about whether generating a defense industry has as a side effect, you often get these tech impressive spillovers. So maybe that story comes later. In the short term, for me, it's very much just about a more normal recovery in Europe.
Okay, why do you think interest rate, cuts don't work in the U.S.? It's very clear that the Fed is trying to say, look, we have these dual mandate, but we're going to focus on inflation a little longer to see where it goes before we cut interest rates.
Yeah, we're still all too obsessed with interest rates in the US. I think particularly in terms of how it drives growth, what we have learned is that so many US actors, households and businesses are on very long-term fixes. And therefore, when the Fed jacked rates up, didn't really have much of an effect. Whether or not the Fed are taking interest rates down, I don't think would have much of an economic effect either. Fiscal policy is much more powerful than monetary policy. And we forget that. We all spend so much time talking about the central banks, but what's happening on fiscal policy, what's happening in Germany is much more powerful, at least in the US. Here in Europe, I still think monetary policy works. We're still on those short-term interest rates, so it has been tight. It's taken money out of people's pockets, and that's getting better.
It feels like there's also, a page turner, Roz, when you look at Chancellor Merz, his spending plans for Germany, but also the fact that now he said to Ukraine that they can go further into Russia, how much of a difference does that make?
Well, there was a lot of attention on those comments yesterday. In fact, it seems like he's now working a little bit to clarify those remarks, because what he was indicating is that all bets are off in terms of Ukraine being able to fire long-range missiles at a variety of targets deep inside Russia. I mean, they're hitting Moscow with drones quite often, but the missiles have some restrictions, including more like border areas for the US, missiles known as ATACMS, the UK allowing a bit further, Germany very cautious about Taurus missiles and sending those to Ukraine at all. So this was quite a moment, but we didn't have the US confirming, we didn't have other countries saying this is true. And today we have the messaging from the German Chancellor, which is actually, he was referring more to the policies that already existed, which is that, yes, there are the opportunities for Ukraine to hit Russia itself with missiles. So it may not be quite a game changer, as we were indicating yesterday. And it shows, again, there's still maybe a level of concern about Ukraine hitting too far into Russia, sites further into Russia with missiles versus drones.
Yeah, and I imagine that complicates things with China on a geopolitical level. And then you look at China from the market's perspective, and they're dealing with, again, tariffs and the stance with the US.
Yeah, I mean, I think the situation for me in China is it's abundantly clear the rest of the world, and I do think actually as we proceed through the next 18 months, we'll hear a more protectionist stance from Europe towards China also. We can't cope with this scale of competition. It's hurting US industry, hence we've got Donald Trump. It's hurting European industry as well. So this is a defining moment in China, I think, for them to decide what is their strategy for growth now. Are they really understanding they've got to generate domestic growth? They've got to stand on their own 2 feet. And I think there is a recognition. We've seen some things from Beijing, particularly in terms of behavior towards businesses. You know, we had that obviously big meeting with Jack Ma and other big names in business in China. They're doing a lot to try and begin the process of stimulating the consumer. I'm not seeing the big steps I want to see. We want to see a much bigger consumer-focused stimulus package, a real proper clean-up of the property market in order to sort of put property prices on a firmer footing. But that is what we're looking for in China, this realization, this acceptance that export-driven growth is not an option for the coming decades, and that we need to see that domestic policy.
Such great insights. Thank you both for joining us. That is, of course, Ross Matheson and JPMorgan's Karen Ward on a range of subjects. A very interesting conversation as we try and tie up everything together. Now, coming up, global bonds rally. The dollar rebounds as Japan indicates it's looking to stabilize its debt market after weeks of sell-off. Details ahead, and this is Bloomberg. Japanese super long bond yields have been sliding sharply after the finance minister sounded out market participants on appropriate issuance amounts for government debt. Now, meanwhile, the BOJ governor, Kazuo Ueda, signaled his intention to continue raising rates if the economy improves as expected.
To the extent that incoming data allows us to gain more confidence in the baseline scenario, we will adjust the degree of monetary easing as needed to ensure the achievement of the sustainable 2% inflation target.
Well, let's bring in Van Ram, our MLife strategist, for more, and then we'll also speak to Rachel Evans. Van, in some ways, the comments by Ueda seem to be in line with what he said recently. So why the rise in yen?
Morning, Francine. Pleasure to be talking to you. The markets forever live in hope, and yen bulls are a special category. They've been expecting the yen to rally to 115, 120 levels for 2-3 years now. That hasn't happened. So when Ueda reiterated what he's already said many times before, as you was alluding to, the markets, that brief flicker of hope surfaced again, and the yen spiked higher. But the important thing, Francine, is that the yen couldn't hold on to those gains. And that is because, the BOJ has been going in fits and starts. They're going at a pretty glacial pace of tightening policy. They're going at once a year, and that is not infusing the markets with any confidence, long-term conviction that the BOJ is going to be able to surmount the inflation problem that they've had. Now, the BOJ has good reasons why they're going slow, why they don't want to make a mistake here, because for decades, this economy, the Japanese economy, has been without inflationary embers, and now suddenly over the past 3-4 years they've been grappling with inflation, and now the BOJ is thinking. The BOJ is thinking, look, I mean, with tariffs, with the threat of tariffs looming over Japanese economy, to what extent and how fast they should push ahead. Yeah. And that is why they're dragging their feet, and that unfortunately is showing up in terms of yen losses.
So what can we expect at the next board meeting then?
Well, I don't think they're going to be raising rates. I think the more interesting bit is going to come from what they're going to revise their bond purchase plan. As you know, long-end yields have spiked in Japan a lot this year, particularly at the 30-year end. We have seen yields explode to the tune of 50 basis points. That's phenomenal, and they don't want to upset that. They don't want the markets to be upset. So I think that the key question for markets will be not whether or not they're going to raise rates. They're not going to raise rates, but what they do with the bond purchase plan going forward.
Ven, thank you so much. Ven Ramdam with, of course, all of the bond yield and some of the yen moves as well. Now, Japan's plans to stabilize its debt markets have led to a global bond rally. The dollar also rebounding, this after a gauge of the currency fell more than 7% this year. We're also joined by Rachel Evans, a senior editor on our EMEA news desk, who for many years is our FX and bonds queen. Rachel, I guess the concern is that, so this is a questionnaire and markets kind of freaked out. So was there something in the positioning of the markets that, means that the questionnaire was a mistake?
So I think this is all about the context in which this questionnaire came. We've got to remember that we've been seeing a lot of pressure in the Japanese bond market in recent weeks around some of these auctions that have been coming through. And there's just been a sense, that these auctions have not been going as well as expected. And are there really enough buyers of JGBs out there as the BOJ kind of winds back its sort of monetary policy and the number of purchases of bonds that it's been making over recent years? So I think the fact that you have this questionnaire coming at this moment where everyone's kind of really alert to this question of supply versus demand is the crucial point. And the questionnaire itself, doesn't say, hey, we're thinking about, changing our bond supply, what do you think? But it kind of sort of tries to get a sense of what the market conditions are at the moment and kind of how comfortable people are with the volatility. And the sort of sense from the market is that this could be sort of a forerunner to potentially sort of pulling back on issuance. And that's why we're seeing kind of JGBs getting a boost today and yields coming in.
But that's, basically the potential reduction in JGBs is, a bit of a relief to a global bond market that just has a lot of issuance out there.
Yeah, absolutely. We've been seeing huge amounts of issuance around the world for the last few years. Obviously, we saw a massive spike during COVID where everyone was putting out loads of fiscal stimulus to try and boost their economies. But that hasn't really gone away. We saw sort of that come in slightly, but it's really stuck around. And when you kind of see sort of the plans in Europe, for example, to kind of fund defence, that sense of supply and bonds coming to the market is really still there. And that has been prompting concern globally, right? We've talked a lot about kind of bond vigilantes and how much can kind of governments keep pushing up those borrowings before investors start to say we need to see more yield in order to take down this debt.
Yeah, is it helping treasuries more than others?
Yeah, so I think treasuries are definitely gaining today. We're seeing kind of big moves at the long end. You're seeing that in Europe as well. And obviously there have been kind of a lot of fiscal concerns that have been kind of weighing on the US picture too. But I think one of the interesting things is you could view, sort of the way in which this questionnaire has come out now as being a little bit of a kind of sop to the bond vigilantes. It's saying, we hear you. And in some ways, if that's a message that investors kind of take away from this, that governments will pay attention to them when they start pushing up yields and start prompting sort of poor or even failed auctions, maybe that emboldens them and prompts them to get more activist elsewhere.
And Rachel, some of the other bond markets have basically shifted already to some of, the shorter dated tenors. I mean, is that a global shift?
Yeah, we've been seeing it as well, kind of in terms of sort of the issuance pattern. So investors have been shifting shorter term, but also governments have been. And, the Debt Management Office in the UK, for example, has been kind of skewing its debt issuance towards the shorter end because they're aware that there is more demand in kind of that sort of 2 and 5 year area rather than in the really longer dated side of things. I think that's also partly due to some of the kind of bigger long-term dynamics. We're seeing perhaps fewer purchases from pension funds who have other assets, perhaps in the private space, that they can look at beyond just kind of government bonds.
Rachel, thank you so much. Rachel Evans there with the very latest on Japan. Now, Bloomberg has learned that HSBC has cut more than 24 analysts in recent days as Europe's largest lender deepens a restructuring of its investment banking businesses. Now, sources say the cuts, mostly in Europe, include the departure of Stephen Major, global head of fixed income research. Now, the restructuring aims to increase efficiency and is expected to lead to $1.8 billion in charges over the next 2 years. Well, joining us now is Bloomberg's Stephen Aaron. So, Steve, I mean, this is a big deal also because, Mr. Major was such a big voice in markets globally. But why is the restructuring happening and why is it happening now?
Right. So I think what's important to see is that this is an ongoing restructuring. This is a manifestation of a plan by the CEO who came in just last year in September and has been trying to cut costs. It's a continuation of that drive. 24 analysts. It's actually, it doesn't sound like a huge number given that HSBC is such a massive bank, but they're high paid. It also underlines that HSBC is cutting back in the investment bank. We reported earlier this year that they are cutting the investment bank, especially in Europe and the US. So this is definitely a manifestation of that.
Steve, separately, here in the UK, NatWest is also getting ready to chart its own course without government help. It is very symbolic, but what does it mean for NatWest?
I think it's definitely a significant step, but it is largely symbolic. I mean, the UK government only owns, I think, below 1% in NatWest now, down from over 80% after the bailout 17 years ago. So the last step, which we expect to happen at some point this week probably, or any time, will only be sort of the last final step to push NatWest into independence. Symbolic, but very significant, drawing a line under the bailout era.
Steve, overall, how are banks doing? We focused on HSBC, on the UK. How are the European banks doing?
They're doing pretty well. Stocks are up a lot this year, with especially Italian and Spanish banks benefiting still from sort of higher interest rates, even though they're coming down. Trading activity is doing pretty well. So banks have had a strong start to the year. It's continuing. Even the share prices are back to where they were before the March tariffs. And so, yeah, it's looking pretty good.
Steve, thank you so much. Stephen Aaron's there with the very latest on the banks. Now, to some other news other stories making news today. And Trump media has jumped pre-market on reports that it plans to raise $3 billion to spend on cryptocurrencies. According to the FT, the move could be announced ahead of a meeting of crypto investors in Las Vegas this week, where the FT reports that Vice President J.D. Vance and Donald Trump and Eric Trump are expected to speak. And you can see pre-market Trump media gaining 8.9%. Coming up, we'll discuss the UK's green energy ambitions and energy pricing with the founder and chief executive of Octopus Energy. He's Greg Jackson. That's next, and this is Bloomberg. Both. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. The EU steps up trade talks, saying it will fast-track negotiations with the U.S. and plans to meet Chinese officials early next month. A sharp fall in Japan's super-long bond yields after an unusual move by the finance ministry as it seeks to regain stability. Plus, Germany clarifies its position on Ukraine, using long-range missiles to hit Russia as allies intensify the pressure on Vladimir Putin. Let's get more on that now. We're joined by Greg Sullivan, our Russia economy and government editor. Greg, thank you for joining us. I mean, this took a lot of people by surprise. What is the actual significance of this move by Chancellor Merz, and how much does it likely help Ukraine on the battlefield? Again, I think every country has their pain threshold on how much they'll allow to Ukraine to go into Russia.
That's right. On the face of this, it looked like a pretty significant shift in Germany's position. This has been a long-standing request of Ukraine. Ukraine wants to be able to strike deeply into Russia to degrade that country's ability to attack Ukraine. We're talking about attacking things like weapons storage, oil and fuel depots, airfields. But up until now, Germany has been reluctant to allow that and has also refused to supply its Taurus missiles. So here we have the shift, though Germany did clarify that this has been long-standing, suggesting that maybe it's not quite as significant. Still, it's likely to be seen as a provocation by Russia, which yesterday the Kremlin, we heard that they said that this was dangerous and likely to widen the conflict. But nonetheless, it does align Germany more with the U.S., which has allowed its ATACMS missiles to be used in places like the Kursk border region, and the U.K. with their Storm Shadow missiles. Still, questions remain over what supply Ukraine will have to actually use long-range missiles to do these attacks, and whether that impact will be big, given that they're already striking deep inside with drones.
Greg, more broadly, how is NATO actually looking to put more pressure on Russia, and how is the European approach to Russia changing?
Europe has definitely been trying to step up their pressure on Russia, especially after this past weekend where we had 3 consecutive nights of attacks, including the largest drone barrage of the war so far. We've heard from European leaders that they do want to intensify pressure in a few ways. One, they are considering widening sanctions, including we know that the EU is considering cutting more banks off from the SWIFT financial messaging service. We also know that NATO wants to step up its defense spending. It's starting to take defense more seriously. It's now targeting 5% of GDP as a defense spending target. Of course, some of that would be for infrastructure and non-hard defense. About 1.5% of that would be non-hard, but still that's significantly more than they have been spending and more than the U.S. spends on defense. So clearly, Europe does seem to be recognizing that it needs to be tougher. It needs to put more pressure on Russia because they've been slow walking in the negotiations and up until now haven't really shown that they're quite ready for a ceasefire.
Greg, thank you so much. Greg Sullivan there with the very latest, of course, on NATO, on Russia, on Ukraine. Now, the UK government says it's confident it can meet the goal of having a clean power grid by 2030. Britain is pushing forward with its net zero plans despite clear opposition to green power by Donald Trump. The US president has criticized the UK's approach to North Sea oil and gas, calling Britain's windfall tax on the oil and gas industry a big mistake. Well, we're now joined by Greg Jackson. He's founder and chief executive of UK energy supplier Octopus Energy. Greg, thank you for joining us. I mean, you are de facto one of the biggest voices out there in terms of understanding, the energy flows, how much labor can actually cut bills by, but also renewables. Can labor, first of all, actually lower, bills without a move to zonal pricing? Zonal pricing for international audience is a peculiarly, quirky British, way of calculating prices.
Yeah, well, I mean, first of all, thanks for having me. And in many markets around the world, we've been moving to more and more renewables. The UK is fairly typical. It's about half our electricity is coming from non-fossil fuel sources. And as we're doing this, what you find is that in one region of the country, it'll be windy or sunny, and in another region, it's not. And so where it's not sunny, we'll be using gas power stations here. Some countries might use coal. And trying to set the price for electricity when you've got this incredibly diverse cost base, wind and solar, high upfront costs, high capital costs, virtually zero marginal cost. Whereas with fossil fuel plants, you've got to pay for the fuel. So as we move into this system, what we're finding is that typically, if you're setting the price for a large market like the whole of the UK, based on traditionally the most expensive unit generated anywhere, it's largely being set by the fossil fuel price, even though half your power is coming from renewables. Now, many markets have fixed this by introducing some form of locational pricing. In the northeast of the US, you have nodal pricing with 12,000 nodes setting the price based on very precise supply and demand in each region. In Sweden, Norway, Denmark, it's been introduced, and indeed Texas uses it, Australia. All those markets are seeing energy costs on average falling because you can take advantage of renewables. Now in Europe, you've got the UK, you've got Germany, 2 huge markets that are struggling with the highest electricity costs in the OECD, crippling business, terrible for cost of living, bad for inflation. And so we need radical market reform. That's the way in which, as you build more renewables, you can get cheaper prices. And that's what zonal's about.
But Greg, I mean, I guess, the concern is that if this government isn't, able to lower the price of energy, full stop, so that our bills are cheaper, then does it put the citizens against renewables? Because there's no real incentive there.
You couldn't be more right. Look, we did some polling in the UK. 43% of UK voters support net zero.
Right.
21% are opposed. So twice as many are in favour. If energy bills go up, support collapses to 13%. So if you want to deliver net zero, if you want to deliver clean energy, you have to focus on bringing costs down. And I should say, look, the technology allows this. A unit of electricity generated from wind or solar, typically around the world, is increasing the cheapest unit of electricity. But until we reform the markets, which, by the way, isn't always good for incumbent companies, consumers are not going to see the benefits.
But is the government, is this high on the priority list of the government? Do they understand how important this is to do it also in a timely fashion?
Very often governments feel they have to choose between going forward on a clean energy programme or going backward to cut bills. But the reality is, with creative thinking, these technologies, with market reform, with brave action, you can do both. Now, that is on the mind of the government. But look, I started a company 8 or 9 years ago that's going to be very big by disrupting incumbents. And I can tell you they don't like it. Now, the market reforms that are required will disrupt incumbents, but without them, this mission will be in peril. But
do you think they'll be able to lower prices on bills, full stop? Will they manage?
Market reform in the UK can bring bills down by about $120 per household per year as a baseline, reducing our dependence on the price of gas. By the way, it will also reduce emissions by 18% because you won't need as many coal-fired power stations, gas power stations, to fill the gaps in the wind.
I mean, debt on energy bills is at a record. Is this something that the government needs to tackle?
We've just been through a fossil fuel crisis globally, certainly in Europe. So a couple of years ago, the wholesale price of gas increased in the UK 15x, similar in other European countries. We're going to be paying the price for that sometime to come.
Greg, I mean, there's a number of things. The UK may be building a lot of wind farms. Are they building too many? Is there a concern that actually the government has wrong policies or priorities when it comes to renewables?
Yeah, so the UK and indeed some other countries may well be building in the wrong places. So look, at the moment, our biggest offshore wind farm is paid to not generate 71% of the time it could be operating because it's one end of the country. There's not enough grid capacity to carry the electricity around, so we pay it to turn off, and then we pay gas power stations to turn on. If we're going to build wind power and we're going to benefit from it, we need to build it many locations, closer to where there's grid connections, closer to where there's population. All of these things will help. But we also need to build a bigger interconnected grid. Europe is beginning to join up because, for example, it's always windy somewhere. So if you've got enough interconnections, you can connect the places that are windy right now to the places that are not, and vice versa at other times. There's even very ambitious plans, like, we backed one to build an interconnector between the UK and Morocco, because it's always sunny there, right? So, in this world of clean electricity, we need to reconfigure the system, but we need to do it in the most cost-effective way possible. And that means taking the cheapest energy sources, wind and solar, and distributing them to where that's needed, but at the lowest cost.
So because the U.S. has a bit of a backlash, I think we're kind of greenlash against renewables, again, is there a danger of mismatch of actually the U.K. going at it alone without the U.S. and then feeling the consequences?
Well, so first of all, we live in a big world, right? And the increasing cheapness, affordability of renewables means that they are absolutely growing exponentially. China last year built 60% of all renewables in the world were built in China. Very rapidly, it's tackling their famous growth in coal plants. It's beginning to reverse that tide. Now, if I look at the US, Texas, not a state known for being particularly
green friendly.
Woke, right, is the one with, I think, the highest proportion of renewables because they're cheapest and you can build stuff there. And the free market capitalist case for renewable energy is stronger every day because these technologies keep getting cheaper. the cost of batteries has fallen 93% in the last 13 years. So grid-scale batteries that you need to help balance a renewable system are getting cheaper. Electric vehicles, despite some of the kind of stuff you'll see in the press, are now 25% of sales in the UK, around 20% in Europe, and they're growing rapidly. Each one of those has got a battery that will hold enough power for a typical European house for the best part of a week. So this system is growing around us. If we try and resist it, it will just cost more. Look, I don't know about you, but if you're crossing a multi-lane highway, the worst place to stop is in between, right in the middle, right?
Yeah, you can't stop, full stop, just because it feels a bit tricky. Greg, when you look at AI and data centers, I mean, this is like the big challenge right going forward, just because we need so much of the energy. Are small modular reactors right to power those?
I mean, they could be. At the moment, though, we're years away from the first ones coming online. We don't really know whether they're going to deliver. I hope they do. Yeah. But first of all, we saw with DeepSeek, which maybe uses 20 times less electricity than previous large language models. The opportunity to make AI much more energy efficient is huge. We don't know where that's going to go. So we definitely need more electricity for it. But it's far too early to call. And I think there's already, some of the projects that were kind of being built on the back of AI demand, are being held for a bit. I think the second thing about, the sort of AI world is we don't yet know whether they can use energy more flexibly. Right. You can locate a large language model, a sort of an AI learning data center pretty much anywhere. So in the US, you're seeing them being built in the areas with the most abundant cheap electricity, by the way, which is typically renewable.
So interesting. Greg, thank you so much. Don't be a stranger. You have to come back to give us updates on all of your projects and what, of course, the UK government is doing. Greg Jackson, their founder and chief executive of Octopus Energy. Now, European car sales dropping in April amid weaker economic growth and uncertainty due to global trade tensions. That prompted consumers to hold off on larger purchases. Well, Bloomberg's Oliver Crook joins us now. So, Ollie, break down the numbers for us.
Yeah, so listen, it's probably not a total shock that the sort of month that a global trade war is launched is when people are not feeling terribly inclined to buy new cars, and that's really what we saw overall in the month of April. I'll break it down by regions first. When you look at the sort of broader Europe, this will include the UK and sort of outside of the EU, sales were down by 0.3%. However, if you were to strip some of those out, the UK down, for example, was down 10%. If you strip that out, the EU actually sold 1.3 percentage in terms of growth there. France was down about 5%, and Germany was basically flat. So that's the overall picture. When you look at the actual engine types, this is always interesting to me to see what kind of cars are actually being sold. When you look at gas and diesel, that was actually down 22% in terms of the sales for the month of April. Hybrids were up 17%. This was really the sweet spot for a number of months in Europe where hybrids were really doing very well. But now EVs up 28% in the month of April and making up 17% of the total market share of all of the cars that were sold in the month of April across Europe. What is interesting when we drill down into the individual brands, and we could talk about a lot of them, really the standout here has got to be Tesla. We've had Elon Musk, as we know, very active part of the Trump administration, very vocal on some European issues. We wonder if that may have something to do with the fact that sales in April for Tesla were down about 49% year on year, down 50% year-to-date sales, down 39%, and their market share in April, 0.7%. Francine, a year ago, Tesla was holding almost twice that, 1.4 or 1.3% market share in all of Europe, and that includes even combustion engine cars. So Tesla getting absolutely crushed when you look across the European market, and that is something we've seen consistently for the last few months for Tesla.
Latest, of course, on the European car sales. Now, coming up, we'll be joined by Adam Posen, former Bank of England MPC member, to discuss his outlook for the global economy in light of the U.S. trade war. That's next, and this is Bloomberg. China's government is considering a new version of its Made in China campaign to boost production of high-end goods, prioritizing technology, including chip-making equipment. Let's go straight to our China economy and government editor, Alan Wong. Alan, what is China planning with this new manufacturing blueprint?
We've learned that China is planning to come up with a new version of its Made in China 2025 plan, focused on advancing China's capabilities in advanced manufacturing. the focus will be on the equipment used in the making of semiconductors, the most advanced kind. Those of you who've been following might remember that back in 2015, the Made in China 2025 plan said that China would want to create a great capacity in building the most advanced kind of machine that makes the most cutting edge of chips, the kinds that we use in our iPhones. But that is one of the rare goals in the original plan that fell short, whereas other areas such as solar panels, batteries, and EVs, China exceeded their original goals. And this is significant because China shows that it is intent on pushing for its manufacturing edge, even though the US and EU have complained about imbalances with the Chinese economy.
Yeah.
And this shows that China is continuing to see manufacturing as a key aspect of its economy, but also that China is hoping to safeguard its economic security because it sees advanced manufacturing as a key part of the future of economies. And by having the domestic capacity to build high-tech products, China is also trying to prevent the U.S. from cutting off its access to those kinds of technologies that make up the future economic growth.
Alan, thank you so much. Alan Wong there with the very latest on China. Now, we're now also joined by Adam Posen, president of the Peterson Institute for International Economics, an independent nonprofit research organization based in Washington. Of course, you all know him as a former member of the Bank of England's Monetary Policy Committee. Adam, as always, thank you so much for joining us. Now, we want to talk about China, we want to talk about the UK and the US, but it feels like the global economy is going through a massive shift.
Yeah.
And frankly, I don't really know where it ends up. Do you?
I have an approximation. Thank you for having me, Francine. I think there's quite an understandable amount of pressure to focus on the day-to-day because so much is happening, and obviously there's money to be made day-to-day. And some of the governments, notably the Trump administration, are also trying to capture the day-to-day. But if you think about it, what's really happened is we've had a regime shift. The U.S. has decentered itself. I started warning about this. You and I talked about this a few years ago about the post-American global economy. It's now here. And what that means is that the U.S. is behaving more unilateral, which it always was, but it's creating an air of uncertainty over the whole economy. And from a financial perspective, a lot of things that used to have zero risk weight, like treasuries, no longer have zero risk weight. And so there's a cascade of effects that comes out of that.
But is it, an economy that's rebalancing, or could it actually be out of kilt?
No. The rebalancing concept was always nonsense. It didn't mean anything because, in the end, no matter what Secretary of President Trump says, there was nothing to rebalance. Right. So the issue is, are they becoming on an unsustainable debt path?
Yeah.
And we had to go more austere after Biden left us with such large deficits, and the Republican Congress and the president are going in the opposite direction. So we're heading towards unsustainability.
Yeah, and we're seeing it today. Actually, there was a big, Japan move that basically repriced treasuries. So there's something, the market is feeling it, but I don't know whether, there would be a big credit event. So a treasury auction that goes badly. When do you see it culminating?
I don't know. I mean, obviously the odds are worse going forward. We do have a couple things going for us that post-2008 and especially roughly 2014, we've got much more solid fundamentals in the financial system. There's the unknowns about the private credit market, but except for that, most people's balance sheets, most people's liquidity is much better. So there is resilience in the system. But this is a fundamental repricing. I think that's right. If we're lucky, it's a step down.
Yeah.
It's not an ongoing repricing.
Does the U.S. dollar as a reserve currency stay, or Lagarde was talking about the euro's big chance?
Yeah, no, I think it's right for President Lagarde to say that. Maybe not in the tone she's taking, but certainly, I mean. The way to think of it is the dollar remains a reserve currency in the sense that we can still fund U.S. treasuries in dollars. And in an emergency, you may have to play a little bit with the interest rate, but you can get funded. But what Lagarde is onto, and which she's right to be onto, is the dollar is becoming less central. That it can't be the sole. You have to have some amount of hedging against dollar assets, which you never used to do.
I mean, one of I think the biggest questions is also what's happening to inflation.
Yeah.
So we know that, Fed governors are worried about inflation picking up all of a sudden, which is why they're probably hesitant to cut interest rates, but it's not showing up in the data yet.
That's true. And I think the Fed, it's like the analogy of the goalkeeper, in a penalty, has to dive right or dive left. And the goalkeeper right now is trying to stay in the middle. But I think they're going to have to dive towards inflation rather than towards recession. It's not there in the data yet, but it's there in some of the expectations moves.
Yeah.
And the issue's never been so much what happens initially due to the tariffs. It's about what gets passed on, what gets followed through in the system. And that's where I think people are overconfident.
So why is it happening?
Why is it delayed, or why is it?
Why is it delayed, and why are people overconfident?
I think it's delayed because it goes with the fact that we live in a world of low inventories.
Yeah.
Everybody moved to the Toyota system to some degree. And so until we work through and get the next batch of inventories, the prices aren't felt. I think there's also a sense of uncertainty, too much uncertainty, that the tariffs aren't going to remain, particularly vis-a-vis China. And so people are waiting. But the fact is, I think we're pretty much where the tariffs are going to be. So then you'll start to feel it coming through.
Adam, what do you do with China right now? And again, in this, everything's a bit muddled. Geopolitics, economics, like market moves. And China's a massive player in this that often gets forgotten.
It gets forgotten, obviously shouldn't be. But on the other hand, China is in a position where it can play things slowly. The really cynical is the old saying of when your enemy's making a mistake, don't interfere. The U.S. is doing so many self-destructive things. But I think the point is China remains, as your reporter was just talking about, it's concerned with self-sufficiency, which is always a mistake, but it's also still got to clean up its own internal messes. China, like the U.S., is mostly a domestic economy.
We're going around the world because I don't speak to you very often in London. And is it, we know that the spending from Germany is a big game changer.
Yeah.
But are we expecting too much of it? Because it'll take a long time to trickle through.
I think we're expecting probably too much in terms of the short-term forecast, Francine. Mm-hmm. It's not going to be a huge stimulus right now. Mm-hmm. But I do think it is, along with the moves of some of the Nordics, Netherlands, Denmark, some of the other countries in Europe, Poland, I do think it is a smaller but real step change for Europe. And this is why Lagarde's comments on the euro are timed well, because this is part of a meaningful shift towards European integration, European functionality. And that does make the euro more relatively attractive long term.
But Europe away from the U.S., closer to China or closer? Where do they find? Europe is not big enough to sustain alone.
Yes,
right?
it is. Yes, it is. I think that's the issue for Germany. Of course, is do you, like China, do you become more of a domestically driven, less of an export-dependent economy? And that challenge is real. But Europe as a whole is a viable economic bloc, and it can trade with the rest of the world. If the U.S. and China are bullying the rest of the world and putting geopolitical conditions on their trade, Europe, and I was arguing this in the Tommaso Padoa lecture at the Brussels Economic Forum last week. Europe can lean into being its best self and say, okay, you don't want Chinese students? We'll take Chinese students. Okay, you don't want exports from Africa? We'll take exports from Africa. And it can gain, and it can make deals. Europe's going to be in a good position if it plays it right.
So interesting. Adam, thank you so much. Always too short of time.
Thank you for having me.
For a longer block next time. Adam Posen, president of the Peterson Institute for International Economics. Now, Lynn Martin, the president of the New York Stock Exchange, is on surveillance at 1 p.m. London time. I know they'll talk a little bit about markets and, of course, what's been happening in Japan. Up next, Bloomberg Brief. This is Bloomberg.